Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple
That right there is the problem of many investors today. They think the only way to win big is when their portfolio contains a lot of risk. There's a common saying in the world of investing that nothing worthwhile comes without risk. But while that may be true in some cases, it's just one big excuse to waste your money. Believe it or not, the fastest way to compound your portfolio boils down to just 3 things. And yes, you heard that right. So, in today's video, we're going to take a crash course through the 3 best ways to consistently compound your portfolio with no fluff. And if you stick to the end, we'll be going through some of the terrible mistakes that most investors are currently making that keep their investments stuck in a spot instead of growing. Before we go into the order of the day, how about a quick piece of trivia to charge you up? As an investor, what's the one thing you dream about most? An early retirement? A $1 million portfolio? Regardless of what your answer is, we're pretty sure that it revolves around having your money work very hard for you. And the best way to do that is through compounding. And guess what? Out of the 3 super easy ways to do that, the first effective strategy is to invest in companies that reinvest their cash flows with a high return on capital employed, or ROCE. For the uninitiated, a return on capital employed is a financial metric that measures the efficiency and the profitability of a company in generating profits from its capital. It's simply the amount of money the business earns on the capital invested in it. Here's a simple example for you to understand better. If a company secures a loan from the bank at a 15% interest rate to start their business, and their cost of capital is 15%, reinvesting that loan at a 10% return means the company is losing money. This is a nightmare scenario because the 15% cost of capital is higher than the return on capital, which was 10%. This may sound like a crazy instance, but it happens more often than you think. Some firms just can't balance the cost of capital with their returns by making the former lower than the latter. And no matter what you do, don't add such stocks to your portfolio, as you'll be damaging it in the long run. Even Warren Buffett is constantly on the lookout for companies with a healthy ROCE. As a matter of fact, he gave this smart answer when he was asked about the type of businesses he loves buying from the most. What we really want to do is buy a business that's going to earn a high return on capital employed for a very long period of time. When you stop and think about it, it's rather simple. Remember the last company with a 15% cost of capital and 10% returns? Let's switch things up by using a different company. Here, let's imagine the new firm has the same 15% cost of capital as the previous one, but possesses a more efficient business model with a superior product and increased pricing power. If they play their cards right and reinvest at a 27% return instead of 10%, it'll almost instantly become a wealth-generating entity for investors. Despite the identical cost of capital, the higher return on reinvestment positions this company to create wealth over time. Feel free to peruse each of the businesses that Warren Buffett and Berkshire Hathaway invested in. They always have a long, proven history of high returns on capital employed. They're very effective at creating wealth. Anything short of that does the opposite. Do you remember when Berkshire Hathaway held 4.3 million shares in Costco, worth around $1.3 billion before the pandemic? Charlie Munger loved the stock so much that he tried to convince Warren to own personal shares. But the sage turned the opportunity down because he wasn't really a fan of retailing. However, where are we going with this? Costco is exceptional when it comes to generating consistent returns, which roughly translates into consistent wealth for the investor. Back in the year 2000, Costco was generating a return on capital employed of around 16%. Suppose the average cost of capital is around 10%, representing the price associated with selling equity or obtaining a loan. Costco, consistently surpassing that mark since 1996, has maintained an average return of around 17%. As a matter of fact, Costco's returns on capital employed have been as high as 24% in recent years, which means that the company is consistently making money for investors by generating returns that surpass the cost of capital. Just to recap, if you want to multiply the value of your portfolio quickly, the first step that you have to take is to identify companies that can consistently reinvest their cash flows at a high rate of return over an extended period. And once you've managed to pinpoint a company with a persistently high REOC, the next strategy involves seeking companies with a clear return on capital strategy. This means finding companies that use their cash flows for buybacks, thereby increasing investors' equity in the company. A lot of investors, especially those with passive income portfolios, usually flock to dividend investing, which, to be fair, is an awesome way to make money over time. But there's also another way that firms can return capital back to you, the investor, and that is through buybacks. It's one of the practices Warren Buffett loves so much. And to address this, take a look at this clip.
Whether the company should buy it depends on a couple of things. One is they ought to retain the money they need for intelligent growth prospects.
And would you like to guess one of the companies that excels in this area? Here's a hint. It's one of Warren Buffett's favorite firms to own stocks from. Yep, you guessed it, Apple. Over the past 5 years, Apple has been an exceptional outperformer, with buybacks playing a significant role in the remarkable compounding of its stock price. The tech titan's stock buybacks have been consistently boosting Berkshire's ownership without the sage and his team having to spend a dime. Perhaps that's why Warren Buffett openly stated this.
You know, the good thing about Apple is that we can go up.
Back in 1985, Apple had 13.8 billion shares outstanding, and 2 years later, as a younger company, it began increasing the share count through dilution, a move necessary to raise funds and capital for the company, including employee compensation. During this time frame, Apple followed a dilutive strategy, steadily increasing the number of shares outstanding. At its peak in 2013, Apple had approximately $26 billion in outstanding shares, nearly doubling over the previous decade. However, under the leadership of Tim Cook, the company adopted a new policy, prioritizing excessive cash flow for buybacks with the goal of reducing the outstanding shares over time. Over the past 10 years, Apple has bought back over 10 billion shares outstanding, and the impact of this on your shares would have been tremendous. In fact, Apple has consistently reduced shares at a compound annual rate of 4.7%, delivering approximately a 5% return for shareholders each year over the past decade. Make no mistake, this consistent performance provides a valuable baseline for investors and contributes to the company's upward trajectory in stock price. You see, the reduction in shares outstanding directly enhances every financial metric of the company. A good example is when the free cash flow per share experiences a faster increase when the outstanding shares decrease, and Apple's rapid growth in free cash flow per share is attributed in part to their strategic buybacks. If you take your time to research the best companies that have been doing well for a long time, you'll notice one common denominator. They all practice aggressive buybacks. Before we go into the third step, let's summarize the prior sequences for the benefit of doubt. Guys, when it comes to multiplying the value of your portfolio, the first thing you need to do is identify a company with a high return on capital employed, and afterwards, one with consistent buybacks. Once both points have been satisfied, the next criterion you need to look out for is a company that allocates its cash flow for dividends. This means that company executives return cash to shareholders in the form of dividends, allowing shareholders to reinvest that dividend at a potentially high rate of return. You see, while dividends are undoubtedly an amazing source of making lots of money passively, they differ from buybacks as they put money directly into shareholders' pockets. It's like riding a bicycle with no training wheels attached. With dividends, shareholders are in full control, and the burden is on them to reinvest the funds effectively. One of the best ways to reinvest your cash flow effectively with dividends is by either looking at a company on the watch list, seeing if any of these companies are on a dip, or hey, looking at your own portfolio to identify companies that are on a dip. And after you find some good options, you can proceed to take advantage of the dulling situation and the lowered stock price by using a good amount of your dividends, if not all of them, to buy back into these companies at reduced prices. Now, before you feel squirmy or frightened at the thought of making an investment when a stock is dipping, you should know that this is the best time to actually do so. Remember when Warren Buffett said this?
Anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy.
Remember, the bear market makes smart investors rich, not the bull. That being said, the most crucial part of dividends is how you choose to reinvest them. If you use them to buy more companies that reinvest their cash flows at high ROCE and companies that return cash flow through buybacks, rest assured that your dividends have a lot of power to compound your portfolio astronomically. Nevertheless, now we have talked about the 3 fastest ways to multiply your portfolio, let's move on to the next part of today's video, which is about the common mistakes that people make when trying to do so. For starters, one of the most common mistakes that investors make when buying a stock is doing so solely on the basis of its dividend yield. If you invest in a stock for its high yield without considering the company's return on capital employed, or lacking a consistent buyback policy, you may end up with a lot of bad companies in your portfolio, and that can wreck your portfolio, and by extension, your wealth. These companies, often referred to as value traps, lack the effective growth rates of Apple and Costco. Focusing on companies with effective business models, higher returns on capital, and using dividends to increase share count should be the first thing you do when considering a strategic approach, instead of judging solely on its high yield. Another mistake that investors need to be highly cautious about is investing in companies that award executives and employees huge bonuses and stock awards, as it often transfers value and wealth from investors to the employees and executives. Basically, look out for firms that repeatedly have expenditures that don't create value for shareholders. As a shareholder, you own the company, and if the firm in question is wasting money, it's basically wasting your money. So why should you be happy with it? The third mistake we'd like to point out is investing in firms that are paying out debt, especially those that have accumulated debt at low interest rates. Because as the rates change, refinancing at a higher rate could be a big challenge. It might be more prudent to focus on companies with low debt levels from the start, minimizing the need for significant debt reduction in the future. Finally, it's essential for you to stop following the herd. As a matter of fact, of all the investing sins on this list, Warren Buffett believes blindly following what the majority of the market is saying is the biggest mistake that investors make.
Well, the biggest mistake they make is listening to a lot of other people and buying something because they think it's going to go up next week or next month. And for whatever reason people give you, you should understand what you buy. Now, if you
To solve this problem, always make sure you do your homework before any investment you make. And a good way to follow the plan is by staying in your area of speciality. While going out of your comfort zone might be helpful for self-improvement, portfolios are a different ballgame. Adventurous endeavors might be dangerous, and that's precisely why Warren Buffett has always asked investors to invest in businesses they can understand. While we can admit that there's neither a perfect investment nor a definite road to success, we all need to find companies that satisfy the criteria we've talked about in today's video and heavily invest in them.